The collapse of Carillion, a multinational company listed at the London Stock Exchange, caused shockwaves around the world and multiple parliamentary inquiries in the UK. Prior to its liquidation, the company had over 40,000 employees and revenues of over £5 billion. Its collapse was considered the largest ever trading liquidation in the UK. What is more disturbing is that it had received a clean audit opinion from KPMG. But are stakeholders right to expect a company to continue operating in the future if it has received a clean audit opinion? Accounting standards require financial statements to be prepared on a going concern assumption. This means that there is an assumption that the company will continue its operations for the foreseeable future. If management, however, have intentions to liquidate the company or cease operations, then the going concern assumption cannot be used. Instead, another basis, such as the liquidation basis, can be used. So what is the difference between applying the going concern assumption and the liquidation basis? Let's look at an example. Jenga Enterprises owns investment properties. The fair value of these assets based on expected future cash flows is $450 million. The properties could, however, only be disposed of in the current market for $300 million. After deducting costs to sell. If management use the going concern assumption, the investment properties can be accounted for at $450 million. If the liquidation basis is, however, used, management can only recognize an amount of $300 million. There is therefore a significant difference between applying the going concern assumption and the liquidation basis. It is therefore very important for the auditor and management to assess whether the going concern assumption is appropriate. ISA 570 requires the auditor to obtain sufficient appropriate audit evidence regarding the appropriateness of management's use of the going concern assumption and to assess whether a material uncertainty exists about the entity's ability to continue operations in the foreseeable future. So how does the auditor assess whether the use of the going concern assumption is appropriate? The auditor will start by first looking at whether management have done a formal assessment on whether the company can continue operating in the future. It should be noted that the international accounting standards require management to make a formal assessment of the entity's ability to continue operating over the foreseeable future. Management generally do this assessment by preparing and reviewing budgets, cash flow forecasts, directors' minutes, and reports from their solicitors. Management's assessment must cover at least 12 months from the date of the audit report. The auditor would then review these reports and also assess any assumptions to ensure that they are reasonable. The auditor would then hold discussions with management to determine if they are aware of any events or conditions that could threaten the going concern of the company. If conditions or events exist, the auditor will assess whether they are material uncertainties, and will also assess management's plan to mitigate or address these uncertainties. The type of audit report and opinion issued will depend upon whether the material uncertainties exist and whether they have been adequately disclosed. To recap, the auditor must obtain sufficient appropriate evidence to support management's use of the going concern assumption. The auditor will generally do this by reviewing the formal assessment that management have made and will also make inquiries on whether material uncertainties exist. The type of audit report and opinion issued will depend upon whether material uncertainties exist, and if so, whether they have been adequately disclosed.